On the Street. I'm Mel Schaefer, and today I have the pleasure of speaking with Michael Gayed, the publisher of the Lead Leg Report. Thanks for joining us today, Michael.
I appreciate it, Mel. Good to be here.
So jumping right into it, investors remember, I'm sure, the yen carry trade unwound sharply in August, causing the S&P 500 and the NASDAQ to fall over just a couple of days. Analysts at JP Morgan later that month estimated that the unwinding was about 75% complete. Yet you've remained really bearish on the market. Could what's left of that trade have been sold slowly into this current bull market? And what do you see going into the end of the year?
Well, to be clear, it's not that I'm bearish on the market. It's just that I'm bullish on a tail event, meaning I think we're probably overdue for some kind of extreme, which would be a buying opportunity, right? And that's sort of been a thesis of mine, and arguably I've been early wrong for the last year or so in that argument, year and 4 or 5 months. Yeah, I mean, look, when the reverse carry trade for a moment in time happened, I got all kinds of high fives from people because everyone knows I've been talking about this since October of last year as a risk point. And since October of last year, you look at what's driven equities higher. Yes, it's been tech, but the best performing asset class, or one of the best performing asset classes, has been gold, and one of the best performing sectors has been utilities. Not exactly your quintessential offensive parts of the marketplace. I do think there's still a risk that the reverse carry trade plays out. I don't believe for a second JP Morgan's argument that 75% of it got completed in August. I say that very purposely because this whole carry trade thing has been ongoing for over a decade. You don't resolve a leveraging process that's taken place over a decade in 2 trading days. Now, when you had that VIX spike at around 65 Monday, August 5th, I myself argued, as everyone suddenly became an expert on the reverse carry trade, they probably rally the market very strongly. And that's basically what happened. But now that you've had the dollar surging the way it has because of the Trump win and the yen further weakening because of ongoing inflationary pressure in Japan, you're again, I think, back at another critical point where it looks like the Bank of Japan is going to have to raise rates despite them having pressure not to. And keep in mind, part of my whole thesis around this reverse carry trade deleveraging scenario is it's very much tied to the price of oil, because Japan imports all of its oil. They have to import it in yen terms. As the yen gets weaker, oil priced in yen goes up even further as oil in dollars goes up. So again, it's not that I'm bearish for the sake of being bearish. I do believe that there's a lot of complacency and that, yes, we could still have an air pocket. Your guess is as good as mine as to when. Right? Me identifying conditions does not mean me identifying the mile marker.
So when the U.S. continues to cut rates, is that going to also play into it if Japan is raising rates?
So there's a joint hypothesis problem there, right? Which is that we don't actually know if the Fed's going to keep cutting rates. It's interesting, right? Because as you know, as the Fed has cut rates, rates have actually risen. The bond market's telling them they probably should not cut rates further. And there is a risk of inflation re-accelerating yet again, despite all of the rhetoric and narratives. And Powell, I think, gave himself a little bit of an out by saying, the path to lower inflation is going to be bumpy, which is basically his way of saying maybe it's not going to be a downtrend after all. Or at least that's the transitional type of wording for that. But yes, you are correct in principle that whatever happens to interest rate policy in the U.S. is going to ultimately impact currency movement because of interest rate differentials between the U.S. and Japan in particular. It's not me being hyperbolic. I do believe that this is one of the most consequential shifts in monetary policy we'll probably see in our lifetime. The idea that Japan, which has been in this sort of deflationary funk for as long as it has, that Japan has been this source of leverage for the world for so long, and now they're having to raise rates and deal with inflation, that seems like a really, really big deal that's being underappreciated in terms of complacency and how a deleveraging event can occur.
So you wrote on X, formerly Twitter, the other day, I think it was 2 days ago, that a credit event is inevitable. But what I found the most interesting about what you carried on to say was that you said small caps hold the key.
Yeah.
What do you mean by that? What should investors be looking for with small caps?
So I've been saying that really since, I want to say May of last year. And they're still holding the key, to be clear. The part of the the reason that I've been skeptical. And again, you can say I'm bearish. Fine, say I'm bearish. Although I always say don't short, it doesn't work. You can be bearish by being long only, and that has worked factually. Part of the skepticism that I've had around so much of this is from the very fact that most stocks are still below their respective 2021 highs. Most stocks are small caps, right? So if we define the market from the standpoint of indexation, sure, it's been a bull market. You define the stock market from the standpoint of what has the average stock done across all market caps, it hasn't really been that great of a bull market. It's even debatable that it is because, again, most stocks are still in that 2021 drawdown. Now, small caps are the junk debt equivalent of the equity space, right? Meaning these are highly levered companies, razor thin margins, they're at risk, there's default risk because they're smaller, they don't have the resources. So small caps have been held back clearly because of higher for longer dynamics with interest rates, right? Who knows if they can even survive rolling over their debt against very razor thin margins across the board in these smaller companies relative to the large ones that are eating their lunch, you can argue, which is ironic wording given my fasting. But so small caps have clearly been worried about credit risk. There's no other explanation as to why they have not performed that well. They're being held back by the so-called zombie companies. So small caps are worried about credit risk, but credit spreads are not. Meaning, I just said small caps are the junk debt equivalent of the equity space. Well, junk debt's the small cap equivalent of the bond space, and that's actually done remarkably well. Credit spreads have kept on getting narrower and narrower. The bond market does not perceive there to be any default systemic risk anywhere. And my whole thing for this whole time has been it's two different messages. Small caps are worried about default risk. Credit spreads are not. One of them has to be wrong by definition. So when I say small caps hold the key, it's a question of, are they right or wrong about default risk? So if small caps are right, then the implication is credit spreads are wrong. Credit spreads should blow out. That's your credit event. That's the repricing of the junk debt space to the default risk that small caps have been sensing all along. If small caps hold the key and they're wrong and they push to new highs and they have a real momentum move, then credit spreads were right. In which case, there's a lot of potential for small caps to play catch up because they've been held back so long. So it's not me trying to be overly dramatic. I just think that the question of who is right or wrong will entirely depend on what happens next to the Russell 2000.
Yeah, so I mean, like a lot of our listeners and watchers would love to see small caps go, so they'll be hoping for that.
I would too.
Speaking of credit in a bit of a different way, Target recently released its quarterly earnings report, missed on the top and bottom line, lowered guidance for Q4 and tanked over 20% yesterday. Walmart beat, but it offers more groceries, which a lot of analysts have come out and said that's why Walmart's at all-time highs. Target has dropped so much. And this shows people are spending on essentials. What does this signal coming into the holiday season, and what does it say about the health of our economy?
So I think there might be some element of truth to that. I mean, in general, it's true that retailer stocks, with the exception of Amazon, have languished, right? And you can see that in just the performance of the equal-weighted Spider XRT retailer ETF, which has really gone nowhere for some time. Despite all the narratives around a strong consumer, it doesn't look like they're spending in a way that at least the stock investors are rewarding for some of these companies. In the case of Target, there is another dynamic which I think muddies this a little bit. And this is not to get political, but the reality is Target, you can argue maybe has become a little bit of a target in terms of people not wanting to go and shop there, especially more conservative type of spenders. And I don't mean conservative with their wallet, I mean conservative politically. Because they were clearly pushing a certain message and agenda that was much more on the, in quotes, woke-ish side of things a few years ago. And as we've seen with this mood and sentiment shift in the U.S., as far as kind of the overwhelming win that Trump has, I think there's a lot of people that are just, fed up with companies having an agenda, which they always will, right? But it's a pushback against that. So it's almost like a boycotting type of dynamic, which at the margin will make a difference. So it's probably a combination of the two. Personally, I can't stand either shopping wise, and I don't do groceries because I fast.
It's interesting. Target tried to move up into Canada a few years ago and lasted a very short amount of time before it closed all of its stores and headed back across the border. But you spoke for a minute about Amazon, and my next question, I'm wondering, thinking of this as the holiday season, if people are tightening their pocketbooks right now into the end of the year, we're going to see the effects of that in January, February, when the big tech companies start to release their Q4 earnings. What might investors need to be wary of looking into the beginning of next year, and what could the effect be on the overall market?
I think the main thing is, and it is the real only question that matters, it's going to be less about what the actual earnings are and more about what the reaction is, especially now in the context of valuations being as stretched as they are, right? I mean, it's not a surprise or secret that we are now entering into the historical range of price to earnings or price to sales across the board, where as an asset class, probably the 10-year forward returns for U.S. markets is not going to be all that great, just because your starting point of valuation is as high as it is. So if the reaction by investors across these earnings releases, especially on the tech side, end up suggesting that investors think it's not good enough, then it's probably finally some instead of PE expansion, PE contraction, which would be healthy, although it would take a lot to get the market to be, in quotes, fair value at this point.
Okay, and now I just want to pivot back. At the beginning of the interview, you mentioned gold, and I wanted to talk about gold and Bitcoin and how the dollar plays into things. You posted a meme to X showing Bitcoin sending a warning to fiat currency. What are the big moves in Bitcoin and gold? Bitcoin obviously going to all-time highs and gold having a huge sell-off. What does that tell us about the market?
And you and I both know the word that I use that I will not say to a very kind Canadian audience, which may not be like that type of terminology. Look, gold sold off, but gold's also now rebounding. I actually don't think gold's move is done by a long shot. The Bitcoin move is I think, on a lot of this hope around deregulation and a crypto-friendly administration. They are both counterparty hedges. Bitcoin and gold, the commonality is that they are counterparty hedge. I do wonder if the type of movement and volatility and sentiment around Bitcoin is now again at one of those stages where, independent of a 4-year cycle, we're probably at a point where it's overblown and maybe it starts to reverse. I know a lot of people are not going to like me saying that because they are maximalists in terms of how they think about Bitcoin, but I've seen some interesting data that shows that when volume and certain activity in Bitcoin is as elevated as it is suddenly now, that's actually an inflection point. Because, as I myself have argued, trends persist on skepticism, they die on conviction. And I see far more conviction around Bitcoin's uptrend than I do around gold's. Again, it's not a timing type of comment, but I do think it just should make people pause a little bit as far as how much risk they want to take. I think gold is there's far more skepticism around gold performing better, which to me is exactly why gold might be a better performer. So
talking about traditional mining sectors specifically, I know you've been bullish on copper. What's the big bull case that you see for copper, and what other metals do you think might have their day in the sun soon? And going back to sort of small caps things, when do you think it will trickle down into the junior mining space, or will it?
Yeah, that's the real big question. I mean, look, I as much as there's still a lot of bearishness and fear over China, I do think China can't back away from stimulus. They're going to try to find a way to just keep jamming things and turn things around. And if they're going to turn things around, they're from a demand perspective, when it comes to copper and all commodities, you'd expect that that's very much tied to what China does next. And that's confirmed, by the way, when the stimulus was announced by China and copper had that huge move and then round tripped. I mean, if you really want to get a sense of the true sentiment around China, you don't look at China, you look at the commodity space, right? I'd argue more than not. On the miners side, as you know, gold miners tend to not exactly track gold. Smaller ones can, but the reality is they're still much more tied to the cost of energy from a margin perspective, cost of oil, right, than the price of gold. It's a volatile space. I like miners. I think they're relatively cheap compared to history. I think you just have to size them appropriately. Don't leverage them because of the volatility. And there should be some good opportunities there for some of these companies to really do quite well. I think, though, if you're bullish on gold, you should be outright bullish on gold rather than try and do it through a proxy like a stock on the mining side.
Okay, well, that's lots to think about for investors in evaluating their investment thesis and time horizons during the last few months of the year. Thank you so much for joining us, Michael.
I appreciate it, Mel.